This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call, live from the CNBC TV18 Motilal Oswal studio. I am Reema Tendulkar, with me, Nigel and Mangalam. Guys, so 4 Qs, right? Global markets, IT earnings, it's a Friday, and India-Pakistan. So which one are you most excited about?
What's the big tomorrow. Today, I'm most excited for it being a Friday, and because yesterday we were talking about how the prices have been coming down, I managed to secure one ticket.
So do you want to tell us how much you paid for it?
Well, it's a slight premium to the MRP, but definitely a lot lesser than what it was a week ago. So I managed to do that. You know, getting a match ticket is easy. The train ticket was the toughest one. So let's see how I go. If you see me dancing on top of a train to Chaya Chaya, maybe it's me traveling ticketless.
Don't forget to take that video then.
Yeah, absolutely. I mean, it's going to be
a cracking match, man.
Cracker. I mean,
I just hope that we win. That's all. That's all that matters.
We're going to be watching the match and see. We're trying to spot you in the audience, you know. So just give us cues what you're wearing, what banner you're holding. So we'll be looking out for you.
Not a banner, the India shirt for sure, but it's okay. I mean,
but we've got plenty of action to track in terms of markets.
Indeed, absolutely. So let's start with the first one. GIFT Nifty is currently down close to about 150 points. There are two factors weighing on the GIFT Nifty. One, the US markets, the Dow, the S&P 500, Nasdaq, all ending with cuts of close to about 0.5%. The problem is the US CPI inflation print came in hotter than what the street was anticipating, a jump of 0.4% on a month-on-month basis and 3.7% on a year-on-year basis. This was more than what the street was anticipating. US markets cracked. The US 10-year yield rose to levels of 4.68. So that's reason number one. And secondly, the IT earnings, which came post-market hours, Infosys and HCL Tech, both of them were weaker than what the street was anticipating. Just as a reference, pull up the ADR. Infosys ADR down more than 6-7%. Wipro didn't come out with their numbers, but you get the sense of the sentiment from Wipro's ADR performance. Wipro ADR was down 3.5%. And the problem is both these companies have cut their guidance for the full year. And it's very unusual, right, for a company like Infosys to cut the guidance for the second consecutive time. They started the year with 4 to 7. They brought it down to 1 to 3.5%. And it's further lowered to 1 to 2.5%. So it's very unusual. And I think that spooked the street a bit about the fact that growth recovery expectations have been pushed out even further.
All right, the way I'm looking at it is the bulls, they're going to be betting on HDFC Bank because that's been, the strong point for the last 2 sessions at least. While the bears, they're going to be counting on the tech stocks itself. So that's the way, I see it. And domestic economic data actually was quite encouraging. You had inflation that cooled off a little bit. You had the productivity numbers that looked quite good. So domestic cues are quite good in terms of economic data. Well, the global Q is again in a bit of a tizzy, in a bit of a flux. You have those, the inflation number in the United States that went up. Yields as well were up more than 10 basis points on. But let's focus on the domestic Qs. And the reason I'm saying that HDFC Bank holds the key for the bulls is because yesterday we didn't move too much. And the IT index was under some pressure. So if you pull up a split screen, you'll just look at that. HDFC Bank ends at the high point of the day. The IT index ends at the low point of the day. Let's pull up a couple of weightages then. The tech stocks, they account for around 13.5% weightage. I'm talking about all of them put together. TCS, Infosys, Tech Mahindra, Wipro, all of them are put together. While you have HDFC Bank single-handedly, that has close to around 13.5%. HDFC Bank and Reliance Industries together are nearly around 24%. So if both of them can hold one end up, then they can, save us from this downtick that we're likely to see on all these IT names. And HDFC Bank is approaching very, very crucial technical levels. So the 20, the 50, the 100, the 200 AMA, that's what lies ahead. For yesterday, it closed closer to around 1,550 odd, bouncing off the recent low of closer to around 1,500. What did the FIs do yesterday? Well, they covered some shorts yet again. So yesterday, there were close to 5,000 contracts that were covered out on the short side. And now in the last few sessions, from a peak of around 92,000 short contracts, we have come down to around 70,000 short contracts, which explains why we've seen a bit of a bounce. The options data, 19,800 call, well, that was getting written yesterday. It had close to around 30 lakh shares that saw open interest build up. But on the downside, there were 20 lakh shares that were getting added at around the 19,700 odd mark. So since we did see some bit of writing out there, you have the 19,640 mark, which will be a crucial support zone. The near-term number you're looking at is, the 20 DMA, which comes in around 90,750, and resistance will be closer to around the recent high. But the Nifty Bank, that holds key, and if HDFC Bank performs, then that's going to help the Nifty Bank get back towards that congestion zone. Earlier this week, it went to around 44,700, and from there, it did see some bit of a pullback. So the important levels, you wanted to get past the 50 DMA, the 100 DMA, and then move gradually towards the 20 DMA. So you'll be betting on HDFC Bank if you're a bull, and you'll be saying if this market is still in an uptrend, you look to buy the dip yet again, and in fact, try to play it from there.
Buy the dip, Nigel. That's been the texture of this market itself. And today, that will be tested mainly because of the way the global markets have performed. At the same time, the Infosys ADR has performed as well. What was interesting, however, was yesterday in the dying minutes of trade, we saw the market come off a tad. And that was led lower by, one, the IT index, and second, the inability of the Nifty Bank to cross that, 20, 50, 100-day moving average sort of congestion zone that we're talking about. Will be very interesting to see what happens to Infosys today. Why do I say that? Because one, GIFT Nifty is down about 150 odd points. Everyone will be looking at the IT stocks as a barometer of what happens in the globe. And we all know what happened yesterday with regards to the US CPI, right? Coming in at 0.4%, mildly higher versus estimates month on month, and both year on year as well at 3.7% versus an estimate of 3.6%. Now, had this been in line itself as well, would that mean everyone starts talking dovish? Perhaps not, mainly because inflation is persistent. It's not coming down. Had this been a big positive surprise, then all those dovish comments that the Fed officials had made earlier would perhaps be in line with the inflation data. But now, after this number coming in, yesterday the US 10-year yield increased by about 11 points. In just the last two trading sessions, the reason for the markets to rally was the US yields coming down by 15 points. So one data point comes in and, nearly 66, 67% of that decline has been priced in. The dollar index is also above that 106, closer to 106.5. Yesterday it was below 106. So those are a couple of factors I will be watching out for, and that leads to the big question. Will the Strait now start to firmly price in another hike? Because up until now, there was a possibility that there could be another hike. But now, if it starts to firmly price another hike, then we'll have to see what the global market does, and the concomitant impact of that would be on the Nifty. Extremely short term, we'll be looking at the 50-day moving average on the Nifty, 19,607. And Infosys, the reason why I talk about that is, one, saw a lot of short positions being added yesterday. So at some point, will those shorts cover their positions? It was 2% ahead of numbers lower in yesterday's trading session. And from an FNO standpoint, the 1400 put has the maximum open interest, and it has a premium of close to around 22 odd rupees. So will the Strait look at good numbers coming in from Infosys, or will they worry about the guidance being cut by Infosys? Is something we'll have to watch out for. 1380 will be an important mark to watch.
Well, it's going to be a big cricketing week, Mangalam. So, the way I'd like to put it is your top order, the opening batsman will be Reliance Industries and HDFC Bank. Hoping that they fire, because the middle order is looking a little bit dicey. That's all the IT stocks, because they may not, and then hopefully the tail wags at the end.
Yeah. So in that itself, the top order is playing well. We know that. The thing is, can the middle order find its form?
Yeah.
It's been going through a lean patch. If Infosys comes and hits a few sixes here and there, or maybe sees a little bit of recovery from the lows.
Sixes, I don't think so, but maybe a couple of
runs. A couple of twos.
I think Rima Singh, they're getting into my space now. But the short point I'd like to make is IT has been the place to hide.
Yes.
Yeah.
So, the last couple of days we have seen selling on IT. So from the day's low, will we see a bit of a bounce? Well, we'll know later on in the session. But for the time being, before we move on, let's tell you what's lined up on the show for the first hour today. We'll get you updates coming in from markets across the globe, and Dean Kim or William O'Neill will be joining to discuss the entire global setup. Later on, our research team will bring us CNBC TV18's top 10 stocks for the day. And at around 9:30 a.m., we'll be joined by Nishal Maheshwari, who will be joining in to help us out with some fundamental analysis on all the stocks that we have lined up.
On the equities, Christopher Wood of Jefferies says, in terms of the current portfolio positioning in India, dedicated emerging market investors remain very geared to the consumption story. Whereas the view of Greed and Fear Index is that they should be more positioned for now on the commencing private sector capex cycle. Indian market is still at risk of a near-term correction. This means investors should be looking to add to property, banks and industrial stocks in any pullback in prices. Greed and Fear Index already has 56% of the Indian long-only portfolio allocated to these three sectors.
Right, let's get you some money market calls now. We have views coming in from Lakshmanan V of Federal Bank. He says that higher than anticipated US CPI led to a sell-off in the US 10-year yield, assisting the dollar index to recoup its losses from a 2-week low. This is likely to overshadow the 3-month low that the India CPI print and may put further pressure on the rupee itself. He expects the rupee to trade in a range of 83 to near 83.5 for the next few trading sessions.
Well, and on the bonds, Lakshmanan of Federal Bank says that bond yields remained under pressure in the recent sessions, rising to 6-month high levels of around 7.4%. This has the market discounted the OMO sale possibility, strong economic data from the US, which may keep the US Treasuries elevated. And this pressure could result in domestic yields as well coming down a little bit. He expects the 10-year benchmark bond yield to trade in that range of around 7.25 to around 7.35% range in the coming sessions.